Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to the mechanics behind automated trading systems for MetaTrader 5. Today we're taking a close, educational look at a strategy called Control Chart Reversion. This expert advisor borrows a tool from factory quality control, the Shewhart control chart, and applies it to price. Over the next few minutes, you'll learn how it defines a statistical center line and control limits, how it separates genuine trends from random noise, and how it structures its entries, stops, and targets. Let's explore how it all works together. So what exactly does control chart reversion do? At its heart, this expert advisor treats the market the way a factory engineer treats a production line. In manufacturing, engineers use a Shewhart control chart to tell the difference between normal, random variation and a genuine change in the process. This strategy applies that same statistical thinking to price movement. It begins by calculating a rolling average of recent closing prices over a chosen window, by default 20 bars. That average becomes the center line, the statistical middle of the market. Around it, the strategy draws two control limits, placed a set number of standard deviations above and below the center. The default distance is 2.5 standard deviations, a level where a price reaching that far is statistically unusual. The core idea is mean reversion. When a single bar closes beyond one of those control limits in an otherwise calm, ranging market, the strategy treats that excursion as statistical noise rather than meaningful new information, the kind of stretch that tends to pull back toward the center. But the strategy is careful. It also watches for a sustained run of closes on one side of the center line. If enough closes stack up in a row, that suggests the underlying average has genuinely shifted and a real trend is developing. In that case, the strategy steps aside and avoids fading that move. This is an indicator-based, single timeframe approach designed with liquid foreign exchange majors in mind, such as the euro against the US dollar on intraday charts. It's best suited to traders who are curious about statistical process control and disciplined, rules-based mean reversion, and who want to understand how a system can be built to avoid fighting a confirmed trend. As always, this is educational information only, and every approach to the market carries risk, including the risk of loss. Let's walk through the exact logic, step by step. The strategy works only with completed bars, checking its conditions once each time a new bar opens. On every completed bar, it recalculates three things: the center line, which is the simple average of closing prices over the control period, the standard deviation of those same closes, and from them, the upper and lower control limits set at the chosen sigma distance. Next, it applies the run rule, based on Nelson Rule 2. It counts how many of the most recent closes sit consecutively on one side of the center line. If that count reaches the trend run length, 7 closes by default, the strategy considers the trend confirmed on that side and suppresses any counter-trend entry there. This is the main drawdown control. The system is designed never to fade a move that has already proven itself as a genuine shift. Now to the entries. For a long setup, the strategy looks for a prior bar that closed below the lower control limit, the outlier. It does not enter on that bar. Instead, it waits one bar. If the very next bar closes back inside the band, above the lower limit, the reversion has begun to confirm. As long as there's no confirmed down run in progress, the strategy signals a buy. The stop loss is placed just below the lowest point of the excursion, cushioned by a multiple of the average true range, and the take profit is set at the center line, a short, high-probability objective. The short setup is the mirror image. The strategy looks for a prior bar that closed above the upper control limit. It waits for the next bar to close back inside, below the upper limit, and as long as there's no confirmed up run, it signals a sell. The stop sits just above the highest point of the excursion, again buffered by the average true range, and the take profit returns to the center line. 2 more filters keep entries clean. The strategy requires the calculated risk to be positive, and it requires the distance to the target to be at least a minimum multiple of the average true range, so it skips trades where the center line is too close to be worthwhile. Only one position is held at a time, and the stop and target manage the exit from there. Let's look at the actual MetaTrader 5 code driving all of this. At the top are the input parameters you can adjust. Control period sets the window for the center line and standard deviation, defaulting to 20. EntrySigma sets how many standard deviations out the control limits sit, defaulting to 2.5. TrendRunLength is the Nelson run count that confirms a trend, defaulting to 7. Then ATR period, stop ATR multiple, and min target ATR shape the structural stop and the minimum target, and lot sets the fixed position size. Below that is the long block. The condition named long setup is true when the previous close is below the lower limit. The current close is back at or above the lower limit, and there is no confirmed downtrend. When all three hold, the code reads the ask price for entry, finds the lowest point of the excursion, and places the stop that far below it minus a multiple of the average true range. The take profit is simply the center line. As long as the risk is positive and the target is far enough away, it calls trade.buy with those stop and target levels. The short block mirrors it exactly. The short setup condition is true when the previous close is above the upper limit. The current close is back at or below it, and there is no confirmed uptrend. The code reads the bid price, finds the highest point of the excursion, and places the stop that far above it plus an average true range buffer. The take profit is again the center line, and when the risk and target checks pass, it calls trade.sell. Both sides share the same reversion logic, just pointed in opposite directions. Now let's bring the whole strategy to life on a chart. What you're seeing is a simulated euro versus US dollar market on an intraday timeframe. Running through the middle is the gold center line, the rolling average of closing prices. Above and below it are the two blue control limits, set at 2.5 standard deviations. Think of the space between them as the market's normal range of variation. At the start, price is calm and ranging, drifting gently around the center line. The closes stay comfortably between the two control limits. This is exactly the in control, statistically normal behavior the strategy is watching. There's no run of closes stacking up on one side, so no trend is confirmed, and the system stays patient. Then watch what happens next. Price begins sliding lower, and one bar pushes down sharply, closing beyond the lower control limit. This is the outlier, a Shewhart Rule 1 signal. In a ranging market, a move this far from the center is statistically unusual, the kind of stretch that historically tends to snap back. But the strategy is careful. It does not step in front of that falling bar. Instead, it waits one bar to see whether the move continues or reverses. On the very next bar, price closes back inside the band, reclaiming the lower control limit from below. That reclaim is the confirmation the strategy was waiting for. Reversion has begun, and because there's no confirmed down run in progress, the buy entry marker appears. Notice where the protective stop goes, just below the lowest point of the excursion, with an average true range cushion beneath it. The target is the center line itself, a short, direct objective rather than a distant one. From there, price does exactly what the mean reversion logic anticipates. It climbs back toward the middle of the range, bar after bar, until it reaches the center line, where the take profit closes the long trade. The reward earned is measured against the tight risk taken at the excursion low, and because the stop sat just beyond a fresh low, the distance risked stayed compact. Now the market shifts to the other side, and we get to watch the short setup unfold. Price stabilizes near the center line, ranges quietly for a couple of bars, then begins pushing higher. One bar extends up and closes beyond the upper control limit. This is the mirror image outlier, an unusually far stretch above the center in an otherwise balanced market. Again, the strategy shows discipline. It does not sell into that rising bar. It waits. On the following bar, price closes back inside the band, slipping below the upper control limit. That reclaim signals that the upward excursion is fading, and since no upward run has reached the confirmation length of 7 closes, no real trend is flagged. The sell entry marker appears. The protective stop is placed just above the highest point of the excursion, buffered by the average true range, and the take profit is once more set at the center line. Price then rolls over and drifts back down toward the middle of its range, bar by bar, until it touches the center line, where the take profit closes the short trade. 2 trades, both built on the same principle. Identify a statistically unusual excursion, wait for evidence that it's reverting, then aim for a modest, high-probability return to the average, with a tight structural stop beyond the extreme. And this is exactly where the run rule earns its place. If, instead of reclaiming, price had kept closing further and further on one side until 7 closes stacked up, the strategy would have declared a confirmed trend and declined the fade altogether, stepping aside rather than fighting a genuine shift. That single rule is what keeps this reversion approach from repeatedly leaning against a strong, sustained move. And that brings us to the end of our walkthrough of control chart reversion. Today we explored how this expert advisor borrows the Shewhart control chart from statistical process control, drawing a center line and control limits, fading statistically unusual excursions once they reclaim the band, and using the Nelson run rule to stand aside when a genuine trend is confirmed. We looked at its entries, its structural stops beyond the excursion extreme, and its centerline targets, and we watched both a long and a short example play out on the chart. Remember, everything shared here is educational information only and not financial advice, a recommendation, or a solicitation. Every strategy carries risk, and losses are a normal part of trading. If you found this helpful, please like, subscribe, and leave a comment with the strategy you'd like to see analyzed next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.